Okay, so for anyone keeping an eye on Sri Lanka's financial sector, Vallibel Finance's latest numbers, well, they're definitely worth talking about. We're going to try and cut through all the usual financial jargon today.
Yeah, get straight to the point.
Exactly. And pull out what really matters from their performance in the quarter ending June 30th, 2025.
That's the plan. Taking these sometimes pretty dense reports and just making them clear, what does it actually mean for Vallibel? Where are they headed?
And we're working directly from their interim statements, the balance sheet, income, cash flow, all the notes, both for the main company and the group structure, which includes Vallibel Properties. Think of this as your shortcut to getting up to speed, hitting the highlights, maybe some surprising bits, and what it suggests about their strategy.
Sounds good. Where should we start?
Let's start with the big picture, the sort of overall health check, the balance sheet.
Okay.
And right away, you see this pretty aggressive expansion phase. Total assets for both the company and the group jumped, what was it, 12.4% in just 3 months?
Yeah, that's a big move in a short time. For the company, it hit about 125.5 billion rupees.
Wow.
And what's really driving that, I mean, the scale of it, is mostly their core business lending. Loans and receivables, their biggest asset class, that grew by 14.4%.
Okay, that makes sense for a finance company.
But here's something interesting. There's also this huge shift, really dramatic, in their financial assets measured at fair value through profit or loss, FVTPL.
Oh, yeah.
For the company, that category just rocketed. It went from maybe 134 million rupees to over a billion.
A billion. From 134 million, that's quite a leap.
It really is.
What does that usually signal? I mean, for a finance company to suddenly ramp up fair value assets like that, are they diversifying, maybe playing the market differently?
It could be a few things. Maybe taking advantage of market conditions, maybe reclassifying some things. It definitely suggests more active management. Perhaps taking on a bit more market risk, you know?
Right. And, well, no surprise, I guess, if assets are shooting up, liabilities are too. Total liabilities climbed about 14%.
Pretty much in lockstep, yeah. Both for the company and the group.
And that tells us how they're paying for all this growth.
Exactly. And the how is pretty clear when you look closer. It's mostly fueled by a big jump in interest-bearing borrowings.
Oh, big.
For the company, that specific liability went up almost 59%, from around 12.7 billion to over 20 billion rupees.
Okay, so they were borrowing quite heavily to expand.
Definitely. That's underpinning the asset growth. It's worth mentioning, though, Lanka Rating Agency kept their BBB plus rating on a stable outlook. So for now, the rating agency seems comfortable with this level of borrowing and growth.
Interesting context. So lots of growth in assets, funded mainly by more borrowing, but the owner's stake, the total equity, that didn't grow nearly as fast.
No, much more modest, only about 1% growth there for both company and group.
Okay, so that's the snapshot of where they stand. What about performance? Let's dig into the income statement. How did they actually do in the quarter?
Well, the headline there is profit. It looks really strong.
Yeah.
Compared to the same quarter last year, the company's profit just soared, up 53.8%. And the group did even better, up almost 69%.
Wow. Okay, so the company's profit landed around 785 million rupees.
That's right, and it's coming from a few places. Top-line growth was solid gross income, up nearly 18% for the company.
Okay.
Net interest income, their core bread and butter, grew a healthy 23%. And fee and commission income was even stronger, up almost 33%.
Those are good numbers. But is that the whole story behind that big profit jump?
Not quite. There's another really significant factor here. Impairment charges.
Provisions for bad loans. What happened there?
They dropped dramatically, down by 48%.
48%. That's huge. That's definitely a big boost to the bottom line.
Absolutely. When those charges fall, it usually means the loan book is looking healthier, fewer loans going bad, maybe they recovered some old debts.
Right. But the question is always sustainability, isn't it? I mean, how much of that profit growth is down to genuinely better loan quality versus maybe, a one-off recovery or change in provisioning approach?
That's the crucial question, yeah. Lower impairments are great now, but you want to know if it reflects a lasting trend. Is it really better credit quality overall, or just a particularly good quarter?
We can't quite tell from just this one report, I suppose.
Not definitively, but either way, lower impairments plus the strong revenue growth we saw, it's really pumped up their profitability ratios.
Like ROA and RE.
Exactly. Return on average assets, ROAA, went from about 2.2% to just over 3%. And return on average equity, ROAE, jumped from around 15.7% to over 20.6% annualized.
Those are pretty strong numbers.
They are, but like you said, it makes you really look closely at what's driving them.
Okay, so profitable quarter helps significantly by lower impairment charges. Now let's switch gears to cash. Where did the actual money move? The cash flow statement tells that story, right?
Right. And there's something quite striking here.
What's that?
Net cash generated from operating activities. Last year it was positive. This year, a pretty big negative number.
Negative how much?
For the company, it was negative 6.5 billion rupees.
Okay, hold on. Negative cash from operations for a finance company. What does that actually mean? Usually you expect operations to generate cash.
Well, when you see that in a finance company that's growing fast, it often means they're pushing out new loans really aggressively, dispersing more cash for new loans than they're bringing in from repayments or new deposits.
Ah, okay. So they're basically investing heavily in growing that loan book.
Precisely. They're using cash in their core operations to fuel that growth. And to cover that gap and pay for other things, they're borrowing a lot.
Which we saw on the liability side.
Exactly. Look at net cash from financing activities. Huge positive inflow there, almost 7 billion rupees for the company. And that's mostly reflecting those new interest-bearing borrowings they took on.
So the story fits together. Operations are using cash because they're lending aggressively, and they're funding that gap by taking on significant new debt.
That's the dynamic, yes.
And what does that do to their overall cash pile?
Well, the net result is that cash and cash equivalents actually decreased over the period.
Okay, so that strategy growth funded by debt really shows up clearly in the cash flow.
It really does, and it shows up starkly in the debt-to-equity ratio, too.
How much did that change?
It basically doubled, went from about 97% up to nearly 177%.
Wow, that's a much higher level of leverage, relying much more on debt relative to equity now.
Significantly more. But it's interesting, even with that increased leverage, they still declared a cash dividend, rupees 2.75 per share for the last financial year. And the total amount paid out in dividends was actually higher than the year before.
Which shareholders generally like to see, I imagine.
Usually, yes. Shows confidence, perhaps.
Okay, that gives us the good sense of the financial position, the profit, the cash flows. What about some of the other key indicators, like asset quality? You mentioned impairments were down. Does the data on non-performing loans back that up?
It does, actually. That's a positive trend here. Gross non-performing accommodation, basically. Bad loans before provisions that decreased went from about 4.5 billion down to 3.6 billion rupees.
That's a decent drop.
And even more telling, net non-performing accommodation, that's after factoring in provisions, it actually went negative.
Negative? How does that work?
It means their provisions against bad loans are actually higher than the total value of those identified bad loans. It suggests they're very well provided for, or perhaps quite conservative in their provisioning. It's a strong sign of improved loan quality, or at least very prudent management of potential losses.
Okay, so definite improvement on the asset quality front. What about liquidity? Having cash available.
Well, that's where the picture gets a bit more, let's say, nuanced.
How so?
While asset quality improved, liquidity seems to have tightened. Their available amount of liquid assets actually decreased, and the main ratio, the liquid asset ratio, dropped quite a bit, from almost 21% down to about 15%.
15%. And is that still considered safe?
Well, here's the other part. The minimum required level for that ratio actually increased during the period.
Right.
So while they're still above the new minimum, their buffer has definitely shrunk.
Okay, so let's unpack this. We've got better asset quality, fewer bad loans, which is great. But on the other hand, they have less ready cash, less liquidity, at a time when the rules require them to hold more. What does that combination tell us?
It suggests a balancing act, doesn't it? They seem resilient in their core lending book, managing risk well there. But perhaps the aggressive growth and funding strategy is putting a bit of a squeeze on their liquid reserves.
Is their overall capital position still strong enough to handle potential bumps?
Yes. On that front, they still look very solid. Capital adequacy ratios, both Tier 1 and total capital, are well above the minimums required by the regulator.
What are the numbers there?
Tier 1 is at 13.79%, minimum is 10%, total capital is 18.11%, minimum is 14%. So they have a comfortable cushion there, a good buffer against potential shocks.
That's reassuring. Now, for shareholders, obviously the ratios matter, but the share price probably matters more day to day. What happened there?
That's one of the most eye-catching parts of the report, actually. The share price performance was really impressive during this quarter.
How impressive?
The closing price on June 30th hit 103 rupees. A year before that, it was 42 rupees.
Whoa. More than doubled in a year.
A significant surge, yes. And importantly, the number of shares outstanding didn't change. So this isn't about share splits or anything. It's genuine price appreciation.
So that brings up the question again, doesn't it? Does that massive share price jump reflect the strong profits and better asset quality we've seen? Or is the market maybe pricing in, expectations of future supercharged growth, maybe fueled by all that borrowing we talked about?
It's likely a mix of both, isn't it? Strong current performance certainly helps, but markets often look ahead. Perhaps investors are betting that this growth strategy, despite the increased leverage, will pay off down the line.
And who are the main owners watching this?
The biggest shareholder is Vallibel Investments, private limited. They hold just over 51%. The public float is around 21%, held by about 4,600 shareholders.
Okay. Just to round things off, did the report give much detail on different business lines or the overall company structure?
Yeah, it breaks things down a bit. The group has four main operating segments they report on: lease, loans and advances, investments, and others.
And is one segment dominant?
Oh, absolutely. Loans and advances is clearly the engine room. It drives the vast majority of their income, profit, assets, and liabilities. The segment data really just confirms their core focus is lending.
Makes sense.
The structure also includes that subsidiary, Vallibel Properties, which basically just manages their office building complex. And beyond the segments, you get the usual details on governance. The board, the auditors, Ernst & Young in this case, they're bankers. It paints a picture of the operational setup.
And did they mention any big accounting changes or major events happening just after the quarter ended?
No, they explicitly state no significant changes to accounting policies and no material events occurring after the reporting date that weren't already accounted for. Pretty standard confirmation there.
Okay. So if we try to pull this all together, we've really unpacked quite a bit from these interim statements. It seems Vallibel Finance is in a phase of, significant growth. Assets are up, profits are up sharply.
Definitely. Powered largely by that core lending business, but funded quite heavily by taking on substantial new debt.
Right. So connecting the dots, you get this picture of aggressive growth, really strong profit performance.
But balanced against, or maybe enabled by, significantly higher leverage, that jump in the debt-to-equity ratio, and a noticeable shift in cash flow with operations consuming cash.
And while the asset quality looks better, which is a big plus, and capital is strong,
Liquidity has tightened. So those are the key areas to watch, really. The reliance on borrowed funds, the cash flow dynamics, and that liquidity buffer.
so the key takeaways for someone following this are strong growth in profit and assets, definite improvement in loan quality, but also significantly more debt on the books and tighter liquidity. And of course, that really striking share price performance.
Precisely. It's a dynamic picture.
So maybe the final thought for you, the listener, to ponder is this. How does a company, like Vallibel here, manage that balancing act? Pushing for aggressive growth and profitability while navigating, tighter liquidity and taking on more debt.
Yeah, what are the long-term implications of these trends? For their strategy, for their risk profile, how would you assess that balance if you were looking at it? It's not always a simple answer.
Absolutely. We hope this deep dive gives you a much clearer picture and maybe makes you feel a bit more confident spotting these kinds of patterns and asking these kinds of questions when you look at any company's financial data.
Hope it was useful.